It started with a tweet. Then came the press conference. And before the markets could even breathe, Wall Street was in chaos. Donald Trump has just taken the first step toward reshaping the Federal Reserve in his own image. With nearly a year left in Jerome Powell's term, Trump has publicly announced that he will nominate a new Fed chair if re-elected, a move that many are calling an unprecedented power grab over America's central bank. But here's the twist. It's not just talk. Trump's shortlist has already leaked, and the names on it are sending shockwaves through global markets. Right now, investors aren't just reacting to a future Fed nomination. They're pricing in something far more dangerous, the collapse of central bank independence. And if that happens, the ripple effects could hit everything from interest rates to global currencies to your personal savings. Let's break it down. As of this week, Trump has floated multiple names for Powell's replacement. Among them, Judy Shelton, known for advocating a return to the gold standard and for her deeply controversial stance that the Fed should take direct cues from the White House. Also on the list, Kevin Warsh, a former Fed governor with close ties to Wall Street and a history of criticizing quantitative easing. And Scott Bessent, Trump's current Treasury Secretary, whose aggressive policy views have alarmed establishment economists. And here's the wild card. Trump loyalist Kevin Hassett, one of his most vocal economic defenders who has called for emergency rate cuts and looser capital controls, even as inflation now sits at 2.6%. None of these candidates are conventional. And that's the point. Trump is laying the groundwork for a Fed takeover that would give the executive branch unprecedented influence over monetary policy. In his own words, the Fed has been a disaster. Powell's a numbskull. We need someone in there who understands the art of the deal. Markets didn't take that lightly. Since the beginning of the year, the dollar index has dropped nearly 10%, hitting 98.6, its lowest level since March 2022. Gold spiked to $30,390 an ounce, marking its highest level ever, driven by safe haven demand. Treasury yields swung wildly as bond traders scrambled to reassess rate expectations. And then came the panic. Because Trump didn't stop at the nomination. He's now openly calling for emergency 200 basis point cuts despite the Fed holding rates steady between 4.25 and 4.5% due to persistent inflation and geopolitical risk. That's where this story gets dangerous. The Fed has always operated with a delicate balance, close enough to elected officials to understand fiscal policy, but far enough to resist political interference. It's that independence that gives the dollar its power, that anchors treasury markets, and that reassures global investors that U.S. policy won't change with every election. But if Trump installs a chair who acts on his command, that firewall could vanish. Think about what that means. Inflation could be politically manipulated. Rates could be slashed in an election year. Asset bubbles could be inflated to create artificial growth. And the moment global markets lose faith in the Fed's independence, the consequences are swift. Capital flight, bond sell-offs, currency volatility. And here's the moment that should give you pause. This isn't theoretical. We've seen this playbook before. In Turkey, when President Erdogan installed a compliant central bank governor, the lira collapsed, inflation soared past 80%, and investors fled. The U.S. government isn't Turkey, but the mechanism is the same. When political power overrides monetary stability, the market stops believing in the system. And once that belief is gone, no speech, no tweet, no policy can bring it back. One strategist at C said it best this week. Markets don't fear Trump's style. They fear Trump's control. Let's zoom in. If Trump successfully nominates a loyalist, the first major impact would hit the bond market. Already, futures traders are adjusting their forecast. The CME FedWatch tool now shows nearly 60% odds of a rate cut by September, despite no such indication from Powell or the current Fed board. That shift alone has triggered a surge in demand for inflation hedges, gold, tips, even Bitcoin. It's not about inflation today. It's about inflation without a counterbalance. According to the Bank for International Settlements, more than 60% of global trade is invoiced in dollars. That pricing power exists because the world trusts U.S. monetary stability. If that trust falters even slightly, it could accelerate the already growing movement toward de-dollarization. China, Russia, and much of the BRICS bloc have already begun settling trade in local currencies. If U.S. monetary policy becomes visibly politicized, it gives those countries ammunition to ditch the dollar faster, and that could reshape the global financial order in real time. So how bad could it get? Imagine this. A Trump-appointed Fed chair cuts rates in early 2026 under political pressure. Inflation rebounds to 4%. The dollar weakens. Oil, priced in dollars, surges. Import costs rise. Real wages fall. And just like that, the U.S. re-enters stagflation, driven not by market forces, but by one man's campaign agenda. This isn't about left or right. This is about whether the world's most powerful economy will keep its financial guardrails intact or strip them away in the name of political gain. Because once the Fed becomes just another branch of the presidency, the game changes. It's no longer about stability. It's about control. Watch the markets. Watch the yield curve. And above all, watch the Federal, because the next chair may not be chosen by merit. They may be chosen by loyalty. And if that happens, the damage won't be temporary. It'll be systemic. And there's something deeper happening here, something that's been brewing for years. The Federal Reserve has always operated in the shadows of public understanding. To most Americans, it's a black box of economic jargon and quiet rate decisions. But to global markets, it's the single most important anchor of financial trust. Now that anchor is under attack. Trump's move isn't just about rates or replacements. It's about asserting dominance over one of the last remaining institutions that operates independently of the presidency. If successful, it would mean monetary policy could be weaponized, used not to stabilize markets, but to serve political cycles. And that's not just a risk. That's a blueprint for volatility. Imagine a future where every election brings not just new laws, but new interest rates. A future where inflation expectations are set not by data, but by polling numbers. A future where central bank governors are judged not by performance, but by loyalty. It's happened before in Argentina, Venezuela, Zimbabwe, and every time the pattern is the same. First comes political pressure, then rate cuts, then inflation, then collapse. The U.S. is not immune. Already the cracks are showing. Market volatility is rising. Bond demand is splintering between institutional risk on and retail panic. Currency hedges are back in vogue. And whispers on trading floors are turning into warnings. If Trump wins, the Fed could fall. This moment is bigger than Powell, bigger than the nominees. It's about whether the dollar and everything that relies on it can remain the world's reserve currency in a world where monetary independence becomes optional. And if we lose that independence, the cost won't just be economic, it'll be generational. Because rebuilding trust is the hardest thing in finance. And once it's gone, it rarely comes back the same. So now the question isn't whether markets will react, it's how violently they'll swing once this plan accelerates. We're no longer asking if the Fed will be politicized. We're asking when. Subscribe to Wealth Signal for sharp, factual breakdowns on the forces shaping your financial future before they hit the headlines.